So as we look at kind of the industry and the way it's changing, especially when you think about digital transformation and this balance of trust, security, as well as customer experience, what are you seeing in terms of insights, trends? What are both commercials, right, in the vertical, and as well as financial institutions or those that are regulated? What are those changes that you're seeing occur currently?
One of the things that we're seeing that's a little interesting right now in the market is that there's a big focus on customer experience. So in any market, you're always kind of doing that trade-off between where are we seeing fraud versus how are we prioritizing the customer experience, whether that's onboarding or for authentication. How much friction are you willing to put your customers through in order to make sure that it is not a fraud? Lately, I think one of the things we're seeing is that customer experience has become more and more important due to the competitive nature of the market. Customers are a lot less likely to want to put a good customer through a high friction experience than we've seen in years past. So Liminal actually just came out with a study saying that 88% of the buyers they surveyed are actually willing to lower the fraud threshold in order to increase that customer experience or improve that customer experience today, which is surprising when you pair that with the rise in fraud that we're seeing really across all channels. Gen AI has really given fraudsters the ability to have a lot more tools and technology at their fingertips, which has allowed them to scale their programs very, very quickly. So we're seeing an increase of fraud, but also this increase of customer experience being a high priority for them.
I think what's interesting is, we've seen kind of this transition of losses and risk appetite and even industry changes, that maybe there's some consolidation happening, whether you look at the financial institutions and the mergers and acquisitions that are going on. So your opportunity for customers is shrinking. And so that may also be putting some pressure on risk appetite that says I'm willing to take a little bit more risk on losses and other instances of potential acceptance of fraud. I hate to use the word fraud. Some of it is just the cost of doing business. And in order to get that share of wallet or a new customer. And the most expensive part of onboarding any customer, I think, when you look at it holistically, marketing, employee management of the onboarding process itself, the technology, that's where all of the, the heavy lift of an expense is for, I think, any either corporate or even a financial institution. And so if you're going to invest, I may be willing to take a little bit of risk because it's so expensive to grab that customer in the first place. And if they are a good customer, then I can continue to grow them. How do those some of those statistics, when you think long term as experience, kind of transition into once I've onboarded you, what are we seeing? How does that transition into other types of either risk, exposure, fraud, or even experience?
So there's a couple ways I think that it's going to translate over time. One of them being is with the rise in the synthetic identities, even if you've onboarded that customer, it may be weeks, months, years before you find out that that was actually a bad customer or a risk to your business based on the way that they're curating that identity across many, many markets. The other concern that we have is the account takeover aspect. And that's something that there's a big focus on onboarding and how you make sure you're securing an identity through that process. But the account takeover piece is a big risk as well. And it's not just to your business, but for that customer experience, for that loss piece of it. So, if you're a customer that's been banking with someone for many, many years, and all of a sudden you log in to see your funds have been transferred out due to an account takeover attack, it's a very personal feeling and feels like a lack of trust between you and the business, even if it doesn't necessarily reflect that the business had done anything wrong.
Yeah, and I think the other thing that we're seeing is this expectation from customers that I'm covered. If that risk or I take that loss, that my financial institution or being an account at Verizon or whoever it is going to cover me and make me whole. And that's not necessarily the case, which is a surprise, I think, to the general consumer. How that transitions into, I'll call it bottom line balance sheet over time, is going to be quite interesting, especially if you're willing to take more on the risk appetite side of the equation, right? And silent synthetics, are real.
Right.
And I think that in the future is probably one of the most risky areas, is those that sit on the books and we're not exactly sure who or what they are.
Right.
And then all of a sudden they have the bust out, which causes this ripple effect. Correct.
Absolutely. And through that process, they've also probably been able to better establish themselves to take advantage of other institutions or other markets. So, they may say that you've been a good customer here at Bank A for the last 6 months. I trust you a little more to go take out a bigger loan or a bigger piece that they're going to win and then get off with that's going to be an even bigger loss to a different company before they become a loss at that company as well. So it's really just kind of playing the long game for them in terms of how they're going to get the most money for the reward of playing that long game.
The other thing that I think is the challenge, we always say data is a challenge. Generationally, like you're talking about, right? I can create these credit, right? History, I belong history. And generationally, we're seeing statistics where, certain generations are deciding not to buy a house. We're deciding not to have a credit card or deciding not to have a loan. Makes it easier potentially to generate synthetics, right? Because not a lot of the younger generations maybe have those large in-depth credit verifications or other things that I can say, oh, Carmel really is who she says she is. She's been paying a car payment for 5 years, or she has a home, or all of those things. There is none of that. So what and how in this digital transformation world, industry of data, science, relational, all those things, how does that challenge a company to stay on top of all this and create the right insights to tell me I may have a fraud risk?
It's a really good question, and I think it's one where we're going to have to start to think a little more creatively about what and where we use our data. So I think for especially the younger generations, but you have that problem of the thin files or the underbanked, and that's always a problem. But you're also seeing, I think, the game change a bit. So the historical systems that we've used to gather information about individuals over time, we're not seeing it quite the same way. So I know for the millennial generation, maybe 10 years ago, we worked on a study that talked about the idea of millennials don't want credit cards. They want to go a different direction. But what we found out when we looked into the data a little bit more was actually that they couldn't actually get a credit card until they turned 18. So it used to be people were trying to give you a credit card left, right, and center. All of a sudden, you don't get to start building it.
College,
right? You get little pieces of it in. All of a sudden, you get the
gas card.
Exactly. So they didn't have the opportunity. So what we were actually seeing is that they were applying at high rates, but they weren't getting credit access because they didn't have any history behind them, which then further put it into a cycle of, okay, well, how do you start to build a credit footprint when you don't have a credit footprint? And that makes it very hard for the credit space, but also the identity space. How do you start to know and have built trust behind these individuals if they don't have the opportunities to have some of those trusts?
Right, yeah. This new insights about gig economy. How do I validate that you really are who you say you are for a job, or that you are getting a paycheck, and all of those things? I think this crazy digital transformation that we're going to go through is also going to put pressure on maybe some new products and new capabilities and new intel and insights that need to be used in order to really, say, I'm real.
Right. Where else can we build that trust if it's not in the financial space?
Exactly. So those are some things I think are really quite interesting when we think about 3 to 5 years, maybe 10 into the future of this dramatic change that we're going to in terms of physical to digital.